The following video is an extract from the Udemy course, Learn to Construct Financial Statements from the Ground Up. If you would like to purchase the full course, you can do so by using the link below. Hello and welcome to this lesson where we will be covering some general accounting principles and accounting concepts. When an incorporated entity prepares financial statements, that entity will prepare financial statements in accordance with a relevant financial reporting framework. Which framework used will depend on various factors, including a legal requirement to apply the framework. Depending on the type or nature of the company, a company may be legally required to apply a certain type of financial reporting framework. A second factor is an entity's jurisdiction. An entity's jurisdiction would also determine which type of financial reporting framework is used. For example, a certain type of UK company may have to apply UK generally accepted accounting principles, whereas a US company might then apply another type of financial reporting framework called US generally accepted accounting principles. A third factor might be whether a company is eligible to apply a certain framework. So depending on the size of an entity, this might dictate which framework should be applied. The larger the entity, the more onerous the disclosure requirements within the financial statements might typically be. Finally, sometimes there might be a choice, and depending on the nature of the users of the financial statements, this could influence the framework that is applied. Each framework will have its own specific principles and concepts that should be adhered to when preparing the financial statements under that relevant framework. However, some of the common accounting principles common to many of their frameworks are as follows. The first one is the matching principle. We will cover the matching principle, but this concept is that when revenue is recorded, the related expense should be charged to the income statement at the same time. So the expense that is incurred in incurring that revenue should be recognised at the same time as when the revenue is recorded. So we'll go through an example of that just to demonstrate that principle. The next concept is one that we've covered to date in this course already. That's the Accruals Concept. And as you should hopefully know by now, this is the concept that accounting transactions should be recorded in the accounting periods when they occur, rather than in the period where the cash flows are associated with them. Another principle then is the cost principle. This principle stated that a business should only record its assets, liabilities, and equity investments at their original purchase cost. Certain more complex types of transactions allows for adjusting assets and liabilities to the market value. Using a historic basis of accounting helps eliminate subjectivity or reduces the room for manipulation of figures within the financial statements. This is because using a historic cost of a transaction cannot be manipulated. So that's a positive of using the cost principle. Where frameworks do allow the use of fair value accounting, these accounting treatments or the frameworks tend to have strict regulation to minimise the subjectivity of the market value amount. The next principle is the economic entity principle. This would be an important concept. The economic entity principle is an accounting principle that states that a business entity's finances should be kept separate from those of the owner, partner, shareholders, or related businesses. Therefore, the accounting records for even the simplest business, a sole trader for example, must be kept separate from the personal affairs of the owner or the owners. So this is the economic entity principle, and that's a key fundamental accounting principle. Another principle to be aware of is the time period principle, and this is the concept that a business should report the results of its operations over a standard period of time. This time period should be stated at the top of the income statement, the statement of shareholders' equity, and the cash flow statement. And then another one just to be aware of is the monetary unit assumption. This principle or concept states that all financial transactions should be recorded in the same currency. So if a transaction does happen in a foreign currency, that should be translated to the currency in which the financial statements are being prepared. So this is just some of the accounting principles and concepts. This is not an exhaustive list, but some of the key ones to be aware of. So now we've done that, I'll see you over in the next lesson where we'll be going through and introducing you to the concept or the idea of double entry bookkeeping. So I look forward to seeing you over there. Thank you.